There is a way to invest and build wealth in the equity markets without losing your hard-earned money to a market crash. Only profit and no loss. Is that even possible? You have probably seen a roller coaster equity markets, and apps and advisors are either asking you to stay invested for the long term or switch or rebalance to something safer. What if I told you there is a way to invest in equity markets while protecting your capital? Well, almost. And yes, there are mutual funds designed specifically to do this. In today's video, we're going to dive into the strategy on how this works, and we're going to explore a few mutual fund options that aims to safeguard your money while still giving you access to the equity market growth. Let's break it down. Let's say you have 1 lakh or 10 lakh or any amount to invest. The idea is simple. Start investing just 20% of that into equity markets. So if you have 1 lakh, you invest 20,000 rupees into equity. The remaining 80,000 is invested into a debt fund or an arbitrage fund. Now, let's assume the market crashes by 30% after a year. The 20,000 you have invested in equity would lose 30%, dropping to 14,000 or 6,000 rupees loss on the equity side. While the equity took a hit, the rupees 80,000 that is invested in the debt fund is growing more steadily at say 7 or 7.5% per annum. Now your debt investments stands at about 86,000 after a year. Add all this, and despite the 30% crash in equity, your total portfolio value still holds a steady 1 lakh. This is a practical example of how a capital protection strategy can work using mutual funds, helping you avoid losses while keeping a foothold in the market for the future growth. Now, here's where it gets interesting. You have protected your capital, but how do you create wealth using equity? Equity markets typically fluctuate, and after a sharp 30% correction, there is often a recovery in the following year. So when your portfolio drops by 30%, you can rebalance by shifting rupees 6,000 loss from the debt fund into the equity fund. Now let's say the market goes up by 30% next year. The 20,000 you initially invested in equity, now boosted by the 6,000 rebalance from debt, grows to 26,000. Meanwhile, 80,000 in the debt continues to steadily grow at say 7.5%, growing to 86,000. So by the end of the second year, your portfolio stands at 1,12,000 rupees. This strategy not only protects your capital during market downturns, but also allows you to capitalize on the market recoveries, steadily building wealth over time. Now you might be thinking 1,12,000 after 2 years is less, and this is what you would get from a fixed deposit. So why should you even bother? Well, here's the thing. After 30% drop, the market doesn't just bounce back by 30%, because that would get you to a lesser level than before the crash. A 30% gain on a reduced value actually leaves you about 9% short from where you started. But here's the good news. Historically, after a steep fall, markets often rebound much stronger to catch up with the long-term average returns, typically 10 to 12% annually, including inflation. So after a 30% drop, the market would well go up by 40% or more as it recovers to its long-term trend. If that happens, your equity portion will rise substantially more. Also, when rebalancing, if you move more than what you just lost, that is 6,000, say 12,000 from debt into the equity, when the market surges again, your equity gains are going to become even more significant. If the market rises 40% after the crash, your rebalanced equity portion would shoot up to 28,000 or even higher, resulting in a much larger portfolio value overall. Plus, the debt portion continues to grow steadily. The key here is to take advantage of the market corrections and the recoveries, something a fixed deposit can never do. By protecting your downside and capitalizing on the upside, this strategy offers a far better potential for long-term wealth creation. There are mutual funds that do something very similar to this, and that is the next section. Now you might ask, what if the crash is more than 30%? Or what if the debt portion doesn't grow or generate 7.5%? The idea here isn't to guarantee a huge return every year, but to balance between growth and protection, to give you full capital protection. Equity markets are unpredictable, but they tend to correct themselves after large crashes. And when they do recover, the rebound is often sharper, making up for the deep losses. The category of mutual funds that try to emulate this strategy is the category called the equity savings fund. This is used when your investment horizons are in the range of 1 to 3 year time frame. There are funds in this category which aims to cap the equity exposure between 50 and 20%. Please email me here if you would like to get a copy of these funds and reports. The other advantage of this fund category is that it has equity taxation, although having such a small exposure to equity. This is because they have an arbitrage portion. The arbitrage portion aims to reduce volatility while enabling equity-like taxation. So you actually experience a long-term capital gains of 12.5%. Then there are funds that invest only in low volatility nifty stocks that can spring back relatively faster after a fall. The equity portion aims to generate the alpha within the portfolio. The debt component provides stability to the portfolio. The covered call aims to provide a steady stream of regular income. There is a third way to deal with zero capital erosion while investing in the equity markets, where you don't want to see your capital ever go negative. It is to park or invest your funds in a short-term debt fund or an arbitrage fund and then move the profits or the gains alone into a small cap fund through what is called a systematic transfer option. If you invest 5 lakh rupees in a short-term fund, just as an example, and you transfer the gains of 2,500 rupees monthly into a small cap fund, the best small cap funds have given about 24% return per annum over the past 10 years. The monthly STP of 2,500 into a small cap fund over the last 10 years would have grown to 11 lakh 18,000. The 5 lakhs in debt fund would have grown to about 5.7 lakhs after the monthly STP withdrawal from it. So in all, at the end of 10 years, the 5 lakhs would have grown to 16 lakhs 88,000 approximately, with no significant risk to your capital. Now on this overall investment, the returns work to approximately 12% annually. This is purely illustrative and used to explain the concept. No one can predict the future with certainty. So before investing your hard-earned savings in the equity markets, it's important to understand that there are significant risks as well as potential rewards. Markets can go up and down in a very unpredictable manner. Always consult your financial advisor and use this as a starting point for your research. If you'd like to get a copy of the research, do email me here. If you like the content of this video, please consider liking it, subscribing to this channel. Please do share your views in the comment section.